Hey guys, my name is Brenton Harrison, and before we even get started, I want to say that I hope that you and your family are in good health, both physically and financially, that you haven't been too negatively impacted by what is going on with coronavirus, COVID-19, and the like. I did want to do a video based on all the things that have been going on financially, whether it be the federal stimulus package, people losing their jobs, that hits the key points, the high points of what's going on. So there are a number of topics that we'll cover in this video where there are a lot more details that are associated with them, but they would be videos unto themselves. So for this session, we're just going to hit the high points. And I would encourage you, if it's something we've done a video about in the past, to go back and check those videos for more details or to do your Googling and your research as well, if it's helpful to you. But let's start with the federal stimulus check. So you guys have seen legislation passed, and you've probably seen a number of articles about individuals and families getting checks of $1,200, $2,400, $500 a child, but you're wondering if you're eligible and how that will all work out. So let's get into it. Who gets a stimulus check? The eligibility for the stimulus check in terms of what you make is going to be based on a number that you can find on your tax return called your adjusted gross income. So your adjusted gross income is typically less than your salary, or I should say in many cases it's less than your salary. So I would not assume that if you see a salary or if you have a salary that is above the limit, that you won't get a check. I would check your tax return to see what it says on your adjusted gross income. If you have an adjusted gross income of under $75,000 as listed on your tax return, then you will get a check of $1,200. Now, if you have an income of 75,000 or between 75,000 to 99,000, then what will happen is you will get a check, but that check will be reduced. And it will be reduced by $5 for every $100 you earn over the threshold. So I'll give you an example. Let's say that I have an adjusted gross income of $75,100. Well, that's one increment of $5 in terms of how much it reduces my check. So instead of a check for $1,200, I would get a check for $1,195. So that will go on and so forth. For every $100 you earn above the threshold, your check will be reduced and reduced and reduced. And once you hit above 99,000 in adjusted gross income as an individual, you are no longer eligible to receive that check. For couples, it is literally double. If you have an adjusted gross income as a couple of under 150,000, then you'll get $1,200 per person for a total of $2,400. And if you're within that $150,000 to $198,000 threshold, you will also see your check reduced based on how much more you earn than the $150,000 requirement. If you have children in your house that are under the age of 18 and you're claiming them as a dependent on your tax return, you will receive $500 for each child in your house under the age of 18. That is who will receive a check. Now, here's who won't get a check. First, obviously, if you're an individual or couple and earn above the income limit, you will not receive a check. Those also not receiving checks are college students between the ages of 18 to 24 who are being claimed as a dependent on someone else's tax return. So let's say, for example, I'm a 21-year-old college junior, but my mother is still claiming me as a dependent on her tax return. Well, first, because I'm over the age of 18, she won't get $500 from me, even though I'm her child, even though I'm a dependent on her tax return, because the children's allowance is for those under the age of 18. But I also will not get a check because I don't have my own individual tax return. I'm listed as a dependent on my mother's tax return. You have to have a tax return of your own that you filed for the tax years of either 2018 or 2019 or both in order to be eligible for this check. Now, if you haven't filed for 2019 yet, don't worry because you can go off your 2018 return. But let's say that in 2018, you earned more than what's eligible for the program. And in 2019, you didn't. In 2019, you earned an amount low enough to make you eligible for the check. I would not assume that you can get it, even though you haven't filed yet. You just need to make sure that you file, because if you do, you'll have the stimulus check available to you for the entirety of 2019. It's not as if because you haven't filed by the time they made the announcement, you're somehow ineligible. You just need to make sure that you file for 2019. And whenever you do file, you'll start the process and get the motion going of that check headed on its way to you. So that's who gets the check and who doesn't get the stimulus check. Next, let's go into mortgages. And you could be in a position where, unfortunately, you are find yourself unemployed, or you're a business owner and are not able to bring in revenue as a result of coronavirus, or maybe you're an independent contractor and have seen your income reduced. And if you have a federally backed mortgage, thankfully there have been some I say there's been some allowances that have been made available to you through the federal stimulus package. A federally backed mortgage is a loan like an FHA loan, for example, and it's issued by maybe a private lender, but it is backed and guaranteed by the federal government. And the stimulus package has stipulated that if you have a federally backed mortgage, they have empowered those lenders who process those loans to defer payments on the mortgage for up to a year if the borrower can prove that they have been adversely impacted financially as a result of coronavirus. So if you call your lender and communicate to them that you've lost a job or have lost pay or are unable to do business, they have the ability to defer your payments for up to a year. Now, this is actually something that has been available in the past. It's not like because of coronavirus, lenders are just now making the option available for people to defer payments. It's something that you might have been able to negotiate in the past, but it is likely that in the past, you would have had to make a lump sum payment at the end of that deferral period. So for example, if you didn't pay your mortgage for a year and you didn't pay $12,000 worth of mortgage payments, well, at the end of that year, you might have to make a lump sum payment of $12,000. Thankfully, the government has decided with federally backed mortgages to do what's called a partial claim for the lump sum payment you might owe. Here's the best way to think about this. Let's go back to my example, and let's say that I didn't make payments for a year, and at the end of that year, my lender wants a $12,000 lump sum. Well, what the federal government will do is they will do a partial claim where they will essentially loan you that $12,000 at 0% interest so that you can pay your lender your lump sum payment, but they will add the $12,000 onto the back of your loan repayment period. So it's kind of robbing Peter to pay Paul, but it's giving you the ability to make that lump sum payment. And then at the end of the repayment period, you can pay the amount that you were given by the federal government at 0% interest. That is what has been issued and legislated for federally backed mortgages. Now, you also could have a private mortgage. And with a private mortgage, it's essentially a mortgage that's not backed by the federal government. And if that's the case, I wouldn't assume, and this is the case with private mortgages, with private student loans, with auto lenders, with credit cards, I would not assume that your lender is unwilling to work with you, even if there's not any formal legislation on the books relative to your payments. You want to take a proactive stance and communicate with your lender about any trouble that you're having from an employment status or point of view or an income point of view, and ask them if they will give you the option of either deferring payments or doing interest-only payments during that period, because many lenders are still willing to offer this to their borrowers, even if they're not a federally backed loan. So you can inquire about that, but you also want to make sure that you inquire about the process for reporting those payments during the period. As an example, if I didn't pay my loans because my private lender allowed me to not do so for 12 months, I would want to ask them, will I have to make a lump sum payment at the end of this 12 months? Or I would want to ask them, or I should say, and I want to ask them, how will you report this period to a credit bureau? If I don't pay during these 12 months, are you going to report me as not having paid or report a late payment? You would want to know those pieces of information before you decide your plan of action, but these are things where hopefully you have a lender that's willing to work with you, and that you actually see that there are people and representatives at all forms of government, local government, state government, federal government, that are even encouraging borrowers to report lenders who are unwilling to work with you to the Better Business Bureau or to the Consumer Financial Protection Bureau if you can prove that you have a financial hardship and they have not extended any grace to you. So again, I would not assume that you don't have options. I would always be proactively communicative with your lenders, as opposed to burying your head in the sand and assuming that because you can't pay, that you should ignore them when the time comes to meet your obligations. Next, let's go into student loans. And there are a number of different categories of student loans, even when you get into federal loans. And we're going to go into those so you understand that even though you're seeing news and articles about federal student loans, not all federal student loans are created equal when it comes to the recent legislation. First, understand that there are certain loans that are issued by the federal government. They are federal loans that are issued by the federal government. These are loans that are most likely issued after the year 2010, and it's likely that they're called direct loans. So if you look on your loan statement, there's a loan type called direct loans. And if you have a direct loan, you are eligible for all of the program changes that were made as a result of this legislation. So what were those changes? Well, the first is you will not have to make a payment on these loans. You can if you choose to, but you won't have to make a payment until at least September 30th, 2020. All required payments have been deferred for that period of time. You also will not have to worry about any additional interest accruing on your loans during this period of time. So you don't have to make any payments and you don't have to worry about any interest during this 6-month period. Even better, if you are in an income-driven plan, and we won't go into the details of income-driven plans, but if you have federal student loans and are on one, you know you're on one. And if you're on one, you also know that as a result of those payment plans, you pay on them for 20 or 25 years, depending on your payment program. And if you have any remaining loan balances at the end of that period, it will be forgiven under these plans with some stipulations. But the premise of these plans is you pay based on a percentage of what's called your discretionary income each year. And then after 20 or 25 years, if you have any loans left, those loans will be forgiven. Well, as a part of this package, you will get credit for these 6 months of payments, even though you're not actually paying anything. So for example, if you have 1 year left on your payment plan until you're forgiven, you will not see these 6 months push back your timeline. You will get credit towards these 6 months as if you've been making a payment, even though you are technically not making one. You also, during this period of time, will get credit towards programs like public service loan forgiveness. Again, it's another video for another day in terms of the details of this program, but in summary, public service loan forgiveness is a loan repayment option or a loan forgiveness option for people who work for a nonprofit entity or a government entity to have their loans forgiven after 10 years of payments. And you will also receive credit towards your public service loan forgiveness program, even though you're not making a payment during this period. Doesn't mean you don't have to or can't make a payment. You can make a payment if you choose, but you're just not required to. Those are loans that are issued and owned by the federal government. Now, there are also federal loans that are guaranteed and backed by the federal government, but are actually issued by a private lender. Those are loans that were likely taken out before the year 2010. And those are loans that, for example, could be a Perkins loan or a Stafford loan. And unfortunately, these were not impacted by the recent legislation at all. If you have a privately owned federal loan, your interest will continue to accrue during this period, and you will have your payments continue as scheduled. There has literally been no change as a result of the federal stimulus package. Now, that doesn't mean that there aren't any options for borrowers who have seen their income reduced, or they've been laid off or furloughed, or small business owners who can't do business during this period. If you have a loan that wasn't technically impacted, you can actually still sign up for an income-driven plan like the ones that we talked about on the previous slide. And you can ask if your lender can recertify your income, which basically just means calculate your payment based off of the income that you make to reflect your current status. So if you've seen a drop in pay, you can communicate to them that you've had a drop in pay and you can get your payment reduced. Or if you've lost your job during this period of time but plan to be rehired when all this finished, you may be able to have your required payment dropped to zero, and you'd still be getting credit as paying, even though you're not technically making a payment during this time. You also can potentially put your loans into forbearance. Forbearance is a period of time where you do not have to make payments on your federal loans if you can prove that you have a medical or financial hardship. So that is an option as well for people who have privately owned federal loans, but you do want to be careful because when you take your loans into forbearance, when you leave forbearance, the interest that has been growing as a result of your loans will be capitalized onto your loan balance. That is a much more detailed subject for another time, but just be wary of doing forbearance for the sake of doing forbearance. It's not as easy as that. When you do start making payments again, it could impact how much interest is growing on your loans as a result of that decision. Lastly, and I didn't put it on the slide because technically it would be altering the status of your privately owned federal loan, but you can also explore if you can consolidate your privately owned federal loans into a federally owned loan, like a direct loan. You can do that. In many cases, you can take your federal loans and you can consolidate them into what's called a direct consolidation loan, and you would then be eligible for all of the allowances afforded to you under the federal stimulus package. I didn't put that on the slide because not only would it change the status of the loan, but you also want to be careful because if you have a privately owned federal loan and you've been paying it back under an income-driven plan, aiming to have that loan forgiven, then you will lose the credit for the payments that you've made before you consolidate. So it's not as easy as just consolidating your loans. If you've already been paying on it for 12 years, you don't want to just automatically consolidate because you would lose credit for those 12 years worth of payments in terms of the length of time before you have to have your loans or before you're able to have your loans forgiven. Those are privately owned federal student loans. Now, next we have private loans, just pure private loans, not guaranteed by the federal government. This could be with a lender like a SoFi or an Earnest or a Laurel Road, whomever the company is. You do not want to assume that they don't have forbearance options available because many do. Many lenders in the private student loan space do allow their borrowers to forbear their loans in 90-day increments. So it could be just after the 90 days you're fine, or it could be after the 90 days you have to go back and prove that you still have a financial hardship if you want them to extend the forbearance period. But there are many lenders who offer it, but the way that they offer it is a little different. For many private lenders, they will let you forbear your loan payments for 12 to 24 months in total over the course of the repayment period. So unlike federal loans, where you may be able to forbear your loans for up to a year at a time, with private loans, they may say you can put your loans into forbearance, but the entire time that they are in forbearance throughout the course of your, say, 10 or 15 or 20-year repayment period cannot exceed 12 to 24 months in totality. Now, private student lenders, they do typically go a step further, and many offer resume assistance. They'll help with your job search, and some will even go as far as helping place you if you're an independent contractor looking for work during this period. So if you have a private student loan, you simply want to call your lender and ask them what they have available in terms of programs and assistance for people who have been negatively impacted by what's going on as a result of COVID-19. Those are private student lenders. Next, we have defaulted federal loans. This is a special category for people who have federal student loans who have seen them fall into default, which essentially means that you're about 6 months late on paying your required payment for your loans. And having your federal loans in default is an extremely negative thing. It can lead to your wages being garnished, your tax refunds being garnished. It puts a formal default on your credit report. When your loans are in default, you lose all of the allowances that are issued and available with federal loans, meaning that you can't have them forgiven, you can't place them into deferment, you can't place them into forbearance. It's a major thing. In some states, they will even suspend your professional licenses if you're a nurse or anything in that nature, if you have loans that are in default. Now, if you have your wages or taxes garnished as a result of default, you will also see those garnishments suspended through September 30th, 2020. They will no longer take money out of your paycheck. They will no longer take money out of your tax refund. And you will also, fortunately, have the option of getting credit towards loan rehabilitation if you formally apply for the program. So what is loan rehabilitation? Loan rehabilitation is a process where if you make a certain amount of payments over a 9-month period of time towards your defaulted federal student loans, you can rehabilitate your loans, which takes them out of default. It takes the default off of your credit report, and it restores the privileges that are available to you through federal student loans. Now, the good thing is throughout this period, the 9 months that it takes to have your loans rehabilitated, you can actually get credit even though you're not paying towards the defaulted loans, if you call your loan servicer and ask to apply for the program. So it's a 9-month program, but remember, for the next 6 months, you don't have to make payments towards federal student loans. You can actually call your servicer, ask them to put you into the rehabilitation program, but tell them that you can't make payments. And based on the press release, they should give you the option of getting credit till September 30th, 2020, even though you're not making a payment. So 67% of the requirement of the program, you actually wouldn't have to pay anything as a result of this recent legislation, which is a huge, huge deal. Next, let's talk about small business owners. If you're a small business owner and you're trying to make payroll, you're trying to just keep the lights on, there are a couple of options that are available to you. And the most commonly talked about in the recent weeks has been what's called the Paycheck Protection Program. These are the loans that the federal government has just issued that are offered through SBA approved lenders, which we'll discuss in a second. But before we even get to this, I want to get to one that's a little lesser known. And this was actually available for those who qualified even before COVID-19, and that's the Economic Injury Disaster Loan. The Economic Injury Disaster Loan is a loan that is typically used for people whose businesses might have been impacted by tornadoes, like we just were in Nashville, or hurricanes, or any other natural disaster. And these are loans that are available through the Small Business Administration. Now, the difference between the Paycheck Protection Program, where you have to apply through an SBA approved lender or bank, is the Economic Injury Disaster Loan can actually be applied for directly through the Small Business Association. So you don't have to go through a bank. You can apply directly through the SBA, and you can even potentially be eligible for a cash advance of up to $10,000. So even while you're waiting for your loan to be approved and processed, you could potentially get an advance of cash for up to $10,000. And if you meet certain requirements, that $10,000 cash advance could even be forgiven if you meet the stipulations required of you by the SBA. These loans can be given for up to $2 million for up to 30 years, and the interest rate that you pay on them varies based on the type of business. If you're a small business owner, the interest rate on your loan will be 3.75%. If you're a nonprofit, the interest rate would be 2.75%. As the Economic Injury Disaster Loan, which is different than the Paycheck Protection Program. The Paycheck Protection Program has to be applied for through or with an SBA approved bank or lender, and these loans are available for up to 2.5 times your average monthly payroll, and that has a $10 million limit. So just for example, if you have a monthly payroll of $100,000 on average, then you're eligible for a loan of up to $250,000 through this program. It's up to 2.5 times your average payroll. Now, the good thing is if you maintain a certain percentage of your payroll over an 8-week period, you can have all of that loan forgiven, meaning you wouldn't have to repay it. It would essentially go from a loan to a federal grant that you do not have to repay. But if you do not maintain a certain percentage of payroll over a period of time, you could see that portions of that loan are now not forgivable, and they would be converted into a 2-year loan. So it will be a very low interest rate, but it wouldn't be forgiven. You would have to repay it over the course of 2 years. And again, this is something that you can apply for through your local bank if they are a lender that's approved through the SBA. Lastly, for those who are not business owners, but they are employed or were employed and now find themselves applying for unemployment benefits. Unemployment benefits are typically issued by your state, where you tell them that you're unemployed. They ask your employer to verify this or your former employer to verify this. And based on what you were earning, you get a certain percentage of your previous earnings on a weekly basis. Well, the federal government has increased those unemployment benefits. And on top of what the state is giving, they are also giving you a federal benefit of up to an additional $600 a week. So you would not get either or, it would be both the state benefit and the federal benefit. And they also have extended the benefit period an additional 13 weeks. So typically the benefit period is capped at 26 weeks. They have expanded it to 39 weeks in total that you're available for in terms of your ability to collect unemployment. Lastly, let's cover retirement accounts. Retirement accounts, you're seeing a lot of people who are cash strapped, who are looking for places to cover expenses, and they're looking at retirement accounts. And typically this is a place where if you're under the age 59 and a half, you may not want to access because you could have to pay a penalty to do so. Well, there have been a number of changes as a result of the recent legislation, and the biggest is that the 10% penalty that is typically required for a distribution of a retirement account before age 59 and a half has been waived up to a $100,000 limit. So this means if you have a retirement account where typically if you were to take money out and do so before age 59 and a half, you'd have to pay a 10% penalty. You can now take out up to $100,000 and you will not have to pay that 10% penalty. Now, you could have a type of retirement account where when you take out a distribution, you have to pay income taxes on the amount that you took out. So for example, you took $20,000 out of a 401k or an IRA, it may look like you earned an additional $20,000 when you file your taxes for the year. But thankfully, as a result of this legislation, you can avoid paying income taxes on the amount that you take out this year. If you take the money out this year, you can avoid paying income taxes on it if you pay back the money within 3 years. So for my example, let's say that I took $20,000 out of an IRA right now to avoid having to make a late payment on a mortgage or not pay a credit card bill. I can take that $20,000, I won't pay a 10% penalty, and I won't pay income taxes on the $20,000 as long as I repay it within 3 years. They also, as a result of this legislation, have increased the allowance of a 401k up to $100,000. So before the legislation, what would happen is if you wanted to take a loan against your 401k, you were limited to the lesser of half of your account balance or $50,000. It is whatever was lower. But now, as a result of the stimulus package, you have seen that limit increased to $100,000 that you can access from your 401k, something that you will have available to you as a result of this legislation. I hope that all this was helpful. I know these are trying times. And again, I hope that this information is something that you can use. And I hope that, again, you and your family are in good health, and that this financial impact that you might be experiencing is something that we will see ended very soon. So all the best to you and yours. And we will keep having these videos as things change to make sure that we're giving you the information that you need on a daily or weekly basis. Have a good one.